So, you want to start an aircraft leasing company. The pitch is simple. You buy a plane, you lease it to an airline. The airline sends you a check every month for years without you ever having to sell a single ticket, deal with a single passenger, or worry about jet fuel prices. You just own the metal. Say you buy a Boeing 737 for $55 million. You lease it out at $360,000 a month. Multiply that out and you're collecting $4.3 million a year from one airplane. Do that with 10 planes and you're clearing $43.2 million a year in lease payments. Do it with 100, like the mid-sized players in this industry, and you're at $432 million a year, big enough that governments start giving you tax breaks just to headquarter there. It looks like one of the cleanest businesses in the world. Buy an asset every airline on the planet needs, rent it out, collect the check. So here's the question worth asking before you wire the $55 million. If it's really this easy, why isn't everyone doing it? Because almost none of that $4.3 million is actually yours. You didn't pay $55 million in cash for that plane. Nobody does. You put down roughly a quarter of it, call it $13.8 million, and borrowed the rest, about $41 million, from a bank. That loan isn't free. At a typical rate for this industry, around 4%, it costs you $1.7 million a year in interest before you've spent a dollar on anything else. Then there's the plane itself. It's not going to be worth $55 million forever. Depreciate it the way the accountants do, and roughly $1.8 million of its value evaporates every year, whether the plane is flying or sitting on the tarmac. Add those two numbers together. Interest and depreciation alone consume close to $3.5 million of your $4.3 million in revenue. What's actually left over before tax, before overhead, before anything goes wrong is about $840,000. Against the $13.8 million you personally put into the deal, that's a return on equity of roughly 6.1%, the percentage of your own cash you actually get back in a year. 6%. On a business that requires tens of millions of dollars, a fleet of lawyers, relationships with Boeing and Airbus, and the patience to deal with airlines. A savings bond gets you close to that with a phone call. So if the plane itself barely pays for the bank and its own depreciation, what is anyone actually getting rich on here? The plane was never the business. The loan was. Every lessor in this industry is borrowing money at somewhere around 3.5–4.5% because they've built up the credit rating to borrow it cheaply and lending it back out in the shape of an airplane at a yield of 6–8%. That gap, call it a 2–4% margin. What bankers call 200 to 400 basis points is the entire profit engine of the industry. It's the same trade a bank runs on your savings account. Take deposits cheap, lend them out expensive, live on the spread. The only difference here is that instead of a mortgage, the collateral happens to have wings and a 25-year useful life, which means the aircraft isn't really the product, it's the collateral. The lease payment isn't really rent. It's closer to an interest payment on a very specific, very expensive loan. And if you're only earning a 2–4% margin on your money, there's only one way to turn that into a business worth billions. Borrow enormous amounts of it, which is exactly what every major lessor does. 70 to 80% leverage on every aircraft they own, sometimes more. AerCap, the biggest lessor on earth, carries roughly $30 to $2.50 of debt for every dollar of its own money, with total debt running several times what it earns in a year before interest and taxes. That leverage is what turns a thin spread into a multi-billion-dollar industry. It's also the thing that can end it overnight. Here's the problem with running a business on borrowed money at a fixed spread. You don't control the cost of that money. Someone else does. Move interest rates up by a single percentage point, and AerCap's own numbers show a hit of roughly $32 million in pre-tax income for every $3.2 billion of floating rate debt sitting on their books. Scale that across a balance sheet built entirely on leverage, and a single move by a central bank can wipe out 15% to 20% of a lessor's net income without a single airline missing a payment, without a single plane losing a lease. Nobody in this business decides that number. The Federal Reserve does, or the ECB, or whichever central bank happens to be setting the price of money that quarter. If that sounds like a risk that only shows up in theory, it doesn't. It's the exact mechanism that has already destroyed some of the biggest names in aviation finance. In 2008, the largest aircraft lessor in the world was a company called ILF. Over 1,000 planes, more than $60 billion in assets. On paper, one of the safest fleets in aviation. The planes were fine. The airlines leasing them were, for the most part, fine. What wasn't fine was ILFC's parent company, EG, which had built an entirely separate business betting on credit derivatives and lost $62 billion in a single quarter when that bet blew up. ILF funded itself through short-term borrowing that depended on EG's credit rating. When that rating collapsed because of a business that had nothing to do with airplanes, ILFC's ability to borrow collapsed with it. It took over $15 billion in emergency funding just to keep the company alive. 6 years later, AerCap bought what remained for $7.6 billion, a 40% discount to what the fleet was actually worth. Notice what actually killed ILFA. Not a bad airplane, not a bad airline. A financing structure that made its survival dependent on a company gambling on something that had nothing to do with aviation. A smaller lessor, Babcock & Brown, ran an even more extreme version of the same bet that same year, 85% to 90% leverage, funded through short-term credit facilities backing assets meant to last 25 years. When credit markets froze solid in 2008, there was nowhere to roll that debt over. $9 billion in debt, and the bondholders recovered essentially nothing. Different companies, same lessor. The leverage that makes the spread profitable in a calm year is the same leverage that can erase the company in a bad one. But leverage isn't the only way this business breaks. There's a second way, and it doesn't need a global credit crisis. It just needs one airline to stop paying. Because the lessor doesn't actually get paid by the aeroplane. It gets paid by whoever is flying it. In 2012, Kingfisher Airlines in India defaulted, and more than 15 lessors found out how thin that protection really was. Unpaid rent alone ran to roughly $185 million. Then came the part nobody plans for. Indian regulators sat on the paperwork to deregister the aircraft for over a year, which meant lessors legally owned planes they couldn't physically take back. Once they finally got them, 34 aircraft needed 18 to 24 months of remarketing before they earned $1 again. The maintenance reserves Kingfisher had been paying the safety net every lessor builds into these deals covered less than half of what it actually cost to restore the planes. One lessor, Boeing Aviation, spent roughly $90 million in legal fees and repairs just to recover what it was owed. Add up the unpaid rent, the restoration costs, and the downtime across all 15 plus lessors involved, and industry estimates put the total damage at several $100 million. A quieter version played out the same year with MALV, Hungary's national airline, when the government pulled its financing under EU rules, and the carrier folded almost overnight, leaving lessors holding jets worth roughly 35% less than they'd been a few years earlier. Owning the plane never meant getting paid. It meant owning a claim on an asset that could be legally yours and physically unreachable at the same time. So, if the spread is this thin and the downside this brutal, where's the actual money? It's hiding, not in the lease payment. somewhere quieter. Every month, an airline wires more than rent. It also pays into a maintenance reserve, often over $150,000 per aircraft, cash set aside for the day an engine needs a multi-million-dollar overhaul. That money doesn't just sit there. It waits, sometimes for years, earning interest the whole time. Across a fleet, that float alone can quietly generate $60,000 to $250,000 a year per aircraft. Money nobody sees in the lease rate, money that shows up nowhere on the pitch. Then, the lease ends, and something even stranger happens. Airlines overfund those reserve accounts on purpose, just to avoid penalties for handing back a beat-up plane. Return the aircraft below spec, and the lessor keeps the shortfall. Return it in better condition than required, and the lessor has to give it back. In practice, the coin lands one way more often than the other industry estimates unreturned reserves at 5 to 8% of everything collected. There's a third layer, and it looks less like renting and more like trading. Lessors don't hold a plane for its full 25-year life and watch it fade to zero. They sell it often into the cargo conversion market once it's aging out of passenger service and walk away with gains north of 15% over book value. In 1 year alone, AerCap sold 98 aircraft and pocketed over $3 billion doing it. And underneath all three layers sits the quietest advantage of all. Structure the ownership through an Irish Section 110 vehicle, a specific type of holding company built for exactly this, and a meaningful slice of that profit gets taxed at a rate close to zero. A fraction of the 12.5% everyone else in Ireland pays. None of this shows up in the 6.1% return on one airplane. Stack the float, the unreturned reserves, the trading gains, and the tax shelter on top of that thin spread, and something changes. A business that looked barely profitable starts to look durable. Unglamorous, but durable for whoever survives long enough to collect it. For whoever survives long enough to collect it. That's the catch, hiding inside the last sentence. So run the clock forward 20 years and see what survival actually pays. Take $30 billion, compound it at AerCap's roughly 12-13%, and it grows into $289 billion. Compound that same $30 billion at the S&P 500's 10.4% instead, and it grows into $217 billion. No debt, no defaulting airline. No refinancing deadline hanging over your head. $70 billion separates those two futures. Looks like an easy win for the aircraft business, until you look at the road in between. A 60 to 80% collapse in 2008. A 40 to 50% collapse in 2020, when every plane on Earth sat grounded at once. Twice in 20 years, this business came close enough to zero that it needed a stranger to save it. The index never fell past 37% and climbed back out in months, not years. Measure the return against what it cost to survive getting there, and the aircraft lessor comes out earning roughly half what the index pays for free. None of this means aircraft leasing is a bad business. For the companies actually built to run it, it's a genuinely good one. AerCap, Air Lease, and the handful of others at real scale have something an individual buyer never will. Investment-grade credit that makes their cost of funds cheap. A fleet large enough to absorb one bad lessee without going under. Direct relationships with Boeing and Airbus that guarantee delivery slots years in advance, in-house teams who know exactly what an engine overhaul should cost before an airline tells them, and tax structures built by people who do this for a living. That infrastructure is what turns a thin margin into a business worth tens of billions of dollars, and what let AerCap survive two of its competitors going to zero. None of that infrastructure exists for the person who imagines wiring $55 million for one airplane and collecting the difference. At that scale, you get all of the leverage risk, all of the interest rate exposure, all of the lessee risk that took down Kingfisher's lenders with none of the scale, none of the credit rating, and none of the diversification that makes the math work for the companies who actually run this business well. Which leaves the real question the way it always ends up. Do you want to own the airplane or do you want to own the spread? Because you can get exposure to the same margin, the same maintenance float, the same tax structuring, and the same 20-year track record through a share of AerCap stock, bought in 10 seconds, without personally signing a single loan, chasing a single defaulted airline through an Indian court, or explaining to a bank why your one aircraft is sitting empty in the desert. The airplane was never the asset, it was the collateral. The real business was always the loan standing behind it, and that's a business you can own a piece of without ever touching a plane.